Welcome to the first video in the series, How to Protect and Even Grow Your Portfolio in Any Type of Market. This video series is part of Retirement Planning Academy and will help you become a smarter investor. In this first video, we're going to cover many of the myths that Wall Street wants you to believe, and then what you should actually believe once you look at the data and how that will help you better control risk in your portfolio and overall give you better peace of mind during any type of market. My name is Dieter Scherer. I'm a certified financial planner, quantitative investment manager at Adaptive Wealth Solutions, and I'm founder of RealizeYourRetirement.com. When I first got into this industry, I believed what the industry at large believed. Buy and hold for the long run through bull markets and recessions, regardless of what the market was doing. But I'm naturally curious about everything, so I started to study the reasoning behind the claims. And as I learned more and more about the myths that you'll hear today, I realized that when you delve deep into the data, the common ideas about the market don't have any basis in much of what the actual data tells us. So it made me question all of these myths and create this presentation to help you become a more insightful investor that sees the entire picture and can make better decisions going forward. So, after combing through thousands of different investment papers, books, articles, and interviews, I've brought you this information contained in this course. And today we're going to cover the myths of Wall Street. Then we're going to go into in future videos, how the average investor sabotages their own portfolio and what the best investors in the world do to avoid the mistakes that most investors make and also guard their portfolios in any type of environment. Each video builds upon the previous video, so you'll get maximum impact from the series if you watch it from the beginning and then watch all the videos in order. Without further ado, let's hop into the video series. Please pause the video for the moment and look through the disclosures that describe how a lot of these data are created, as well as some of the assumptions behind them. All right, let's get started. The first myth that we're going to cover today is buy and hold for the long run. Now, this is a very prevalent myth throughout the financial industry, so let's see what we can do to bust it. So one of the reasons why buy and hold is so favored amongst investment companies is because it's really good for them. Think about it. If you're an equity fund manager and you only make money when people are in your specific fund, not when they're in bonds or gold or real estate or anything else, you're going to tell them that they should hold your fund throughout the bull market and then hold it all the way through the bear market. They'll tell you to hold it for the long run and to focus on the long run. Well, what they don't tell you is that the long run is a really long time. And in the long run, as John Maynard Keynes says, we're all dead. And so John Maynard Keynes actually made a great point in the 1930s when he said, this is the longer quote, "This long run is a misleading guide to current affairs. In the long run, we are all dead. Economists set themselves too easy, too useless a task if in tempestuous seasons they can only tell us that when the storm is long past, the ocean is flat again." And you see, just replace economists with investment managers for like mutual funds or any specific type of strategy, and you'll have a very apt quote for today's markets. So buy and hold, I would say, is safely dead for investors, and we're going to go through why that's the case. Because the long run, a lot of the time, for most people, they think 3 to 5 years. In actuality, the long run is a time period that lasts 80 years, 100 years, much longer than any of us will invest. As you can see in this chart, for the past 115 years or so, there have been numerous periods where we've had 18 years with a negative return, cumulative return, 25 years with just a barely positive return, 1.69%, another 17 years with 0.83%, and another 11 years, which we saw most recently between 2000 and 2010, with only a 0.7% cumulative return. Now, the only way you would get the long run returns that many people quote are if you invested throughout this whole period, many of which, when people pitch their funds to retirees, they don't include that point, and they just say the long run you'll earn 10%. But when actuality, you might go 11 years and only earn 0.7% in the stock market. And so when many people say now's a great time to buy in stocks, many people like brokerage companies and the like, they'll show you a chart like this. And this one's from a big brokerage company you may know. And it says generational lows lined up overlay also suggests risk of cyclical top in 2010. And they mention cyclical top because they want to say it's only going to be a small blip on the radar and then things are going to go back up. In actuality, this kind of material is just cherry picked. They just took a bunch of charts that looked alike and, didn't use any rigorous methodology. They're just like, hey, these charts look alike, and so we're going to put them all together and say that today looks a lot like this, so tomorrow is going to do the same thing. I much prefer to do things quantitatively, but there are two principles of stockbroker economics. The first principle of stockbroker economics is that all news is good. The second principle is that the market is always cheap. So a lot of people will find a lot of different ways to tell you that today is a good time to buy equities because of this reason or that reason. A lot of them are often superficial. So if we look at a solid methodology that's based in statistics and solid, robust math, what would that look like? Well, here we have the stock markets, again, over the last 115 years. But down at the bottom, we have something called the CAPE. And the CAPE is just a long term that stands for the cyclically adjusted price to earnings ratio. If you think about the price to earnings ratio for the market as a whole, it's the price of the S&P 500 divided by the earnings of all of the companies in the S&P 500. And here we average that out over 10 years just so we have a lot less variability in there, and it actually shows more predictive power than just 1 year. If you look at the bottom here, which shows the CAPE, we can see that at every top of the market, we see that the market is higher than its long-term average of 15. And in the Great Depression, right prior to that, we see it peaking right below 30. We see it peaking again during the early 60s or late 60s, and then again with the tech bubble. So when the tech bubble burst, it of course had the highest valuation of the markets we ever had, and we've had this sideways market ever since with multiple bull and bear markets, the financial crisis, the tech bubble bursting, and now the choppy markets that we are currently in. And so the buy and hold myth was really created during this kind of period right here, where the markets just went straight up. But if the markets aren't going to go straight up, what can we expect them to do over the next 10 years? Because we're still at high valuations for the market. Well, if you look at the starting price to earnings ratio for the markets, we can see that at low starting price to earnings ratios, the average 10-year return is pretty high in the 10% range after you take inflation out. And the worst real returns after you take inflation out are still in the positive range. We're down here between 25 and 46, and our average real rate of return is 0.5%, and the worst 10-year rate of return is negative 6%, and the best rate in this category is 6.3%. So we're not looking at very high returns going forward. One of the things I like to do, though, to verify that anything is not just a statistical anomaly within the US is test it against different markets. So here we're looking at 15-year returns versus the CAPE ratio. Up here on the left, we have cheap markets with high returns, and down here on the right, we have expensive markets and lower returns. And we're not only looking at the US, here we're looking at the US in black, Germany in yellow, Japan in red, and all other equity markets in blue. And as you can see, we have a nice trend line where cheap markets have the high returns, and then we see it decreasing as market valuations get higher, and we see lower 15-year returns, with the lowest dominated by Japan that had that massive bubble in the 1980s. So a quantitative ratio like this has a lot of predictive power across many markets. We're right in here, so we might expect something between 5 and 3% based on 15-year returns over the next 5 and negative 3% over the next 15 years after you take out inflation. So another thing I like to do is compare one ratio. I don't want to just use one ratio. I want to use multiple ratios just to validate my hypothesis. And so if we take a whole boatload of different ratios that have been shown to have a good amount of predictive power, here we have the CAPE. 1.1% is the estimated long-term real forecast for the next 10 years. And if we look at all of these other ratios, we see that the returns forecast for the next 10 years range from 0.5% to 3.5%. If you compare that to the long-run average of the past 100 years of 7.2% after inflation, you see that the long-term, long-run returns don't necessarily happen over what we might consider the long run. 100 years, we're all dead. So not only are we at the end of a bull market in stocks, we're also at a bull market in bonds. And before you freak out, don't worry, we're going to go into some solutions later, but I just want to really show that this myth is busted. So across all periods between 1926 and 2015, we have an annual average return of 5.5%. Currently, we are in we have been over the past 30 years, a falling bond or interest rate environment. So as interest rates decrease, when interest rates go down, the prices of bonds go up. So not only are you paid the interest, you also have price appreciation on your bonds, where they're worth more tomorrow than they are today. And so during a falling rate environment, like the past 33 years or so, we have annual returns of around 10%. Currently, we're at all-time lows or near them for interest rates. And so what will happen when interest rates start to rise? Well, during a rising interest rate environment like the post-war period between 1945 and 1982, interest rates rose a tremendous amount up to those sky-high rates that you saw when you're trying to get your first mortgage, say, during the 1980s, or trying to buy a car. Those types of rates, very, very much higher, which we've been coming down from ever since. Well, when interest rates go up, bond prices go down. And so you lose money to price appreciation. You have price depreciation, and you're only getting lower interest rates at the beginning. And so during a rising rate environment, we're only looking at 2.25% for annual returns, like it was from 1945 to 1982. So 60% stocks and 40% bonds are extremely unlikely to offer the same returns of the past 30 years going forward over the next 10 to 15 years. So we need to develop and implement better risk management strategies in our portfolio so we don't have to rely on the long-term averages that many of us will not live to see. Myth number 2 is that you just need to buy the market. Now, buying the market means buying something like the S&P 500, because the S&P 500 is the largest 500 stocks in the US, and it's just weighted by size. Now, people say this because they assume you can't beat the market because they assume markets are efficient. And essentially what markets are efficient means is that everyone knows all public information and all agents are rational. The problem is markets are not perfectly efficient. As Warren Buffett says, I'd be a bum on the street with a tin cup if the markets were always efficient. In a perfectly efficient market, you believe that all people are rational, that they make everything based on logic. But in a mostly efficient market, you see people tend to be irrational. They buy it, sell at the wrong times, and they tend to make emotional decisions during crises. For example, the 1987 crash, the financial crisis, the tech bubble bursting, or the tech bubble even as it was going up in prices. People irrationally thought prices were going to go on for internet companies. They were going to go up forever because we're in a new paradigm. In a perfectly efficient market, all facts are known about companies, and so you would not be able to learn anything by digging through the balance sheets of companies or by looking at price charts or price patterns or technical patterns or some quantitative indicator. In a mostly efficient market, the same facts are known. Most people act on the same information. This is like the herding information that you see, the herding patterns that you tend to see when everyone's talking about the same things. For example, when Enron was lauded as the world's most innovative company for several years in a row, and everyone cooed about how great of a company it was. Whereas some people were able to look at the public information and figure out that Enron was in fact a sham and that it was an accounting fraud, that it was going to collapse. And so in a perfectly efficient market, that would not happen. Just like a 20% drop in a few days, like in 1987, would only happen in 1 out of a billion years. And so everyone knows all of the facts. But in real markets, most people don't know everything about the markets. They know about a slice of information. And so there's a lot of information asymmetry too, because some people have access to all of the financial data, and most of the public do not, because financial data is very, very expensive. And so you have this information asymmetry that causes everyone to not know everything. And when you think about it, the real world doesn't really look like a perfectly efficient market like economists would want to believe in their theories and in their perfectly rational models. It looks like a mostly efficient market, and the difference between those is huge. It doesn't mean that markets are impossible to beat. It means that they're just very difficult, which is night and day. So Warren Buffett says, again, the disservice done students and gullible investment professionals who have swallowed EMT has been an extraordinary service to us. Because while everyone was just believing that you shouldn't spend time trying to figure out smarter ways to do things, he was able to take advantage of that and invest much more intelligently. So market cap indexes that just invest based on size, they'll put a largest allocation to the largest companies. So Apple has around twice the allocation in the S&P 500 as does the second largest company. And that tends to inadequately reward risk with returns. You can see this by, if you take many other types of weighting methodologies, they all beat the S&P 500 over time. Even equally weighting the S&P 500, which you see over on the far right, beats the cap-weighted S&P 500 by 2.4%. And so all of these beat it between 1.5% and 2.4%. You can also take random letters of companies. And so say I want a portfolio filled with just C companies, it will tend to do a lot better than the S&P 500. Even companies that have just X's in them tend to do at the beginning of them tend to do better than the S&P 500. The author of this particular chart just wrote out his name and saw how it would do. And so companies that started with J, O, E, or L were all combined together, and they tended to do better, which shows that size weighting is an inefficient way to weight your portfolio when even randomized letters tends to do better. And if you look at it, it's because there's 75% of stocks collectively had a total return of 0%, and only the best 2,000 performing stocks accounted for all of the gains. And so size, just weighting by size, does not differentiate between these two categories of stocks. what we want to do instead is to eliminate as many from this category as possible and try to capture at least some of these so that we have a better risk return profile. And there are numerous ways to do that that are better than just investing in the market cap indexes. Myth 3 is just to tough it out during market downturns. This has a lot to do with, the buy and hold for the long run thought process. And as we saw, buy and hold for the long run takes a long time. So toughing it out during market downturns may not necessarily see you made whole right after the recession or the market crash. Sometimes it takes 20 years before your portfolio is made whole again. And so one of the reasons this is that finance does not use normal average returns. So if you think about an average, it's 50% law. If you lose 50% and gain 50%, the normal average is 0%. But in finance, if you gain 50% in year 1 and lose 50% in year 2, your actual account value is not 0, it's $750. So your average return is 0%, but your annualized return is negative 13.4%, with a cumulative return of negative 25%. If you only lose 10% in year 1 and have a 10% gain in year 2, you again have an average return of 0%, an annualized return of negative 0.5%, and a cumulative loss of negative 1%. So you have to pay attention to average returns versus annualized returns, because if you have an average return of 50%, that loss is going to make a bigger difference than a gain of 50%. This is because the losses for the gains required to recover from large losses increase much faster. So a 10% loss requires an 11% gain to get back to even, but a 50% loss requires a 100% gain to get back to even, not a 50% gain. This is even worse with even larger losses than 50%. And the unfortunate mathematics of a 75% decline would require your portfolio to increase by 300% to get back to even. And that's around 10% a year for 15 years. And if you think that's not possible, this has actually happened before in the Great Depression. And there have actually been 30 declines of greater than 20% since 1900, and 10 declines greater than 40% since then. And so there have just one of the biggest rules you can learn for investing is to avoid large losses in your portfolio. Now, as you can see, avoiding large losses was much more important to the end value of the portfolio than having an equally large gain. That's why Warren Buffett's 2 rules of investing are rule number 1, never lose money, and rule number 2 is to never forget rule number 1. So we need to take a focus on how we avoid losing money more so than how we gain money, so that we can get ahead by not losing. Myth number 4 is that you can't predict when losses occur. And this is a prevalent myth because it's nigh impossible to determine what exactly is going to happen next year. But there are circumstances where losses are more likely to occur. So when those circumstances do occur, avoiding the markets is generally a very good idea. As you can see in this chart, it shows you how difficult it is to forecast on average, because on average, between 1982 and 2009, almost every single year, or rather every single year, the economists said that the economy was going to grow. And as you can see, the darker line is what the economy actually did. A lot of the time they were projecting growth when there were steep contractions within the economy. And so they extrapolate that into saying you can't predict when losses are going to occur, period, because none of us are very good at it. I really like to agree with Rupert Murdoch in saying that economists were created to make weather forecasters look good, because economists' track record in doing this is very terrible. So if we're to follow our rule, avoid large losses in your portfolio, what do we have to do? Well, the famous trader Paul Tudor Jones once stated that I'm always thinking about losing money as opposed to making money. So if we begin to take a focus on risk instead of returns, you can better to start prepare your portfolio for when those times do occur. Now, one of the favorite things of mutual fund companies and brokerage firms is to focus on what would happen if you missed the best days. Now, this shows if you're invested in every single day in the S&P 500 and you excluded dividends, what would your return be? Well, it would be 4.86%. If you missed the best 1% of days, your return would go all the way down to negative 7%. This is generally where most mutual fund companies stop and say you should always invest for the long run and never get out of the fund because you can't predict when the best 1% days are going to occur. So if you get out, you may miss those and you're going to harm your returns. Well, the corollary to that is if you miss the worst 1%, your returns shoot up to 19% per year. And that is a tremendous difference. Again, it would be very difficult to predict exactly which days were the worst 1%. But if you were to miss both the best 1% and the worst 1%, those extremes, if you were to cut them out, you'd do slightly better on average. You'd do about 0.6% a year on average, and your portfolio would have much less volatility. So I would be much more likely to want a portfolio that gets rid of the extremes and has a much smoother return as we go along. As it happens, the best and the worst days tend to cluster. And they tend to cluster just the same time throughout most market cycles. And so here's how you can miss both the best and 1% worst 1% of days. So as you can see here, when the market is below its 10-month average, 70% of the worst days occur. That also happens with the best days. So both the best days and the worst days occur. And only some of the best days occur above the 10-month moving average. And so this tells us that these all cluster when the markets are going down. Because when the market's below its 10-month moving average, it's generally in a downtrend, and there have been significant losses. And those losses are going to continue once it's under there. And this shows that those 1% of days, those extreme days, they tend to happen one after another. And so if we're only going to invest when the market is above its 10-month moving average, we're able to increase our return to around 10% here and lose. But if we were to invest only below the 10-month moving average, we'd lose an average on 4% each year. We also reduce the risk, the volatility, how much our portfolio fluctuates if we only invest when the markets are trending upward above its 10-month simple moving average. And we would have much higher risk below that. And so that one simple risk measurement allows us to drastically cut the risk in our portfolio and increase our returns. Myth 5 is that financial advisor means advisor. One thing that many people do not know is that the term financial advisor is not a regulated term within our industry. you can call yourself a financial advisor even though you're a salesperson. And so many insurance agents and stockbrokers call themselves advisors when they're actually salespeople, and they do this to like improve their credibility, because advisors typically is a connotation reserved for people that can objectively evaluate your current scenario and then give you objective result or solutions to your problems. Sales and commission paid insurance agents and salespeople, they are not going to be objective because the way that they're paid has conflicts of interest built into it, because one product may offer a higher commission than another product. So it's the difference between a pharmaceutical rep and a doctor. A pharmaceutical rep will know his product portfolio very well, but he's only going to think about your solutions in terms of the products that he offers. Whereas a doctor has taken a Hippocratic oath to act in your best interest and will evaluate all options available, not just pharmaceutical options. He may say that you should just stay home and do yoga. That will fix your back problem, no problem. Or you should do surgery. Or you should just lay off doing anything for a little while, and that will make things better because you're just a little overworked right now. Those are all solutions that an objective doctor might say, rather than saying you need these drugs. Now, I don't want to say that there aren't high quality financial salespeople out there. There are. And many of them are very good people that want to do well by their clients. The problem is they can only provide advice about their selection of financial products, and they don't offer objective advice. And so when they call themselves advisors, they're pretending to be objective in fixing your income solutions for retirement, when in fact they're biased because they can only sell the products in their of the companies that they're related to. Now, they might even be related to many companies and say we can offer products from all of these companies, but they're still only thinking about it in terms of products and not all strategies available. So a broker or agent is much more like a pharmaceutical rep because they're product based, and they only are held to a standard that's called the suitability standard. And the suitability standard basically says, is this product fit for your consumption? Will it kill you? No. Is it the best for you? It may not be the best for you, but they don't have to sell you the best thing for you. They can sell you something that offers a higher commission than another product. Whereas a real advisor is much more akin to a doctor. For example, as a certified financial planner and a fee-only advisor, I signed a fiduciary oath to act in the best interests of my clients, and I'm legally held to be a fiduciary, which means to act in your best interests, much like a lawyer has to act in the best interests of their clients, or a doctor has to act in the best interests of their clients or their patients. And it's all advice-based rather than product-based. Now, the advice may say, go take these products and put them into your portfolio, this annuity or these bonds or these stocks, but it's not solely focused on selling products. So you can identify a real advisor if they're a fee only. They aren't going to be selling you anything based on just commissions, and so they're much more likely to only act in your best interest because they're always held to the fiduciary standard. Myth number 6 is that you need to buy financial products. Now, we're sold products because we're told that they will fix our portfolios, whether that's making them less risky or that's providing guaranteed income with equity upside. There's all of these different pitches out there that are created to sell you products, because without them, you're told your portfolios are either vulnerable or not quite where they need to be. And while this may be true for a lot of people, the way in which the products are sold and the products themselves are often lackluster. Even if the idea is good, the execution leaves a lot to be desired. Now, financial products are so very popular because the whole institution of the financial industry works together to sell them. For example, financial news networks earn ad revenue from companies that sell financial products. The investment companies pay for that revenue, and of course, the investment companies make a lot of money from the fees that they're generated as you buy their products. Insurance companies make a lot of money from the more complex annuities, things like single premium immediate annuities, which are the old school type of annuities. They're no longer that lucrative. They might only earn them a 1% commission, whereas insurance variable annuities are very lucrative now with much, much higher commissions. And Wall Street banks and brokers will often set up very complex products that have layers of fees that you may not see. And these come in a bunch of different flavors. First, you have mutual funds. These are the staple of the financial industry for many years. Variable annuities, these are very expensive. Fixed index annuities, these are the new hybrid annuities that have say that you can, no risk, but participate in equity returns. Private REITs, these are the non-traded REITs that are often sold, and we'll talk about them in a minute. And finally, hedge funds. So here we have commissions in dark blue, annual expenses in light blue, and performance fees in green. So a loaded mutual fund is one that's sold on a commission, and it might have a 5% upfront commission and maybe a 1 to 2% annual fee, depending on what type of product you've bought, whether it's something that's more normal, for example, just equities or stock or bonds or real estate, or whether it's like a long short fund or something that's a little more exotic. No load mutual funds don't have the commission, but they still charge a bit more than the equivalent exchange traded fund that you would see out there that covers the same index. These often can have expense ratios up to 2%, and fee-only advisors may use some of these, as well as commission-based advisors that have a wrap program. Private REITs, and there's a saying in the financial industry, private REITs are not bought, they are sold, because a private REIT has an 8 to 9% upfront commission, annual expenses of several percent. So the investment company is making a lot, the broker is making a lot, the commission-based broker, and they're not valued on a very regular basis. So you can think that you have $10,000 in a private REIT, and then the day after they're valued, after say year 3, they might drop 50% or 60%, depending on how poorly they've done. And you can't really get rid of these, or it's very difficult to. So these you should avoid at almost all costs. I don't care what the pitch is. They offer very high commissions, and the upside for you as an investor is not that great. Variable annuities also offer high commissions to the brokers that sell them and extremely high annual expenses. If you add everything up in a variable annuity, it can often get to 3 to 5% in expenses per year. And I don't care what the guarantee is that's on top of that variable annuity. When you're paying 3 to 5% and only earning market returns, it's not a very good investment. In fact, it's not an investment at all. It's more so portfolio insurance, and should be treated as such. Fixed index annuities, again, very high commissions, between 5 and 8%, depending on the product. And then the annual expenses on fixed index annuities will run about 1 to 1.5% if you have an income rider on there. But they make their money by investing your dollars and then reducing the amount that's credited to the fixed index annuity through a bunch of crediting method formulas. So you don't get the whole thing, and they might use price return versus total return. And we'll look at this more in a different video, and I'll just have a couple things to say in a moment about these. But finally, you have hedge funds and hedge fund of funds. Now, hedge funds generally have a 2% and 20%, 2% annual expense ratio and a 20% performance fee. So that means that if you made 10% in a hedge fund, they would first take 2% off the top. So that leaves you with 8%, and then 20% of the profits that are left over. So another 1.6%, leaving you with only 6.4% of the 10%. Not all hedge funds are good. There are some really exceptional ones. It really depends on which one you're in. And so we'll cover this in a few more moments, but most hedge funds do not offer you the value, especially not when you're sold a fund of funds, which is when a manager then chooses all the hedge funds that you might not be able to get into and then adds a fee on top of that. So on top of this 2 and 20%, you might add another 1 or 2% for a fund of funds, and then an advisor's fee on top of that. So when you have layers and layers of fees in financial products, they really add up quickly and hamper your returns. So first of all, most mutual funds underperform. Up here on the left, you can see a study John Bogle did between the 60s and the late 90s that showed, on average, mutual funds underperform their indexes, and these are compared to each of their respective indexes. And this has a lot to do with the process of a mutual fund and the way that they decide how to manage the fund. Most of the time, they'll deviate from whatever process that they have. It's not a systematic process, so they don't have replicable results over a long time period. One year they might be in growth, another year that they might be in value. It's very difficult to find a consistent fund. Those that are most consistent tend to do better, but the average mutual fund does not do that well. And then, of course, most people will look at, say, 5-year period of returns and see that, this fund, or say your portfolio is done poorly, a broker or an advisor might say, oh, we should replace these mutual funds with these. They've done way better. The problem is a lot of those have just done better because their style was in vogue over the past few years. And over the next few years, due to mean reversion, say growth has done really well, it's going to revert to its long-term mean after a while, and it will likely do poorly over the next few years. And so this explains why a lot of the best performing mutual funds will often end up in the worst performing mutual funds the next year. And over a 5-year period, only 24% of mutual funds outperformed and 25% closed their doors. So what we'll often see is just return to the mean for various strategies. And so when people pile into one strategy, expecting it to perform like it has over the past 5 years, over the next 5 years, it may not. You have to look at a lot longer time period and look at consistent funds that have a consistent portfolio process. Also, the more money a fund has in it, the less nimble it becomes, and that's from Morningstar. And this is generally, if you only have so many profit opportunities, say you're a small cap manager, you're looking at small companies, you only have so much of an edge that you can invest in. Say your edge is $10 million. Well, on a $50 million fund, that gives you a lot of profit opportunities. You may not be able to take advantage of all of them, but your capacity to outperform is still there. However, if your fund grows to $1 billion and there's still only that $10 million worth of profit opportunity, that $10 million does not go as far across $1 billion as it did across $50 million. So the highest rated mutual funds also tend to underperform. Here's an interesting study that shows kind of opposite of what you would expect. Typically, when an advisor or broker recommends a mutual fund, they'll refer to the Morningstar rating of the fund. And an interesting paper by Robert Baird was released in 2014 that looked at the returns of mutual funds by their mutual fund rating. And as you can see, 5-star rated funds underperform their lower rated peers, with 1-star funds yielding the best performance over the next 3 years. That's what I was talking about a moment ago. And so that's not to say you should only invest in 1-star funds, which may have their own problems. But in an individual fund, the strategy may be flawed, or the manager may lack skill if it's only a 1-star fund. But here's a good excerpt from the paper. The more important takeaway is that ratings cannot be trusted for U.S. stock funds without understanding the true drivers of performance, including reconciling the management team's selection process against what has or hasn't been rewarded by the stock market. Investors relying too heavily on past performance may be setting themselves up for future underperformance. And that's because in finance, most things tend to revert to the mean, to the average. And so if one strategy is outperformed drastically over the past few years, it may underperform over the next few years. And you have to be prepared for that, but that's often what you can see expressed in these mutual fund ratings here. 5 stars often do poorly, 1 stars will often outperform. Another thing that you need to take into consideration is whether an investor, whether an investment manager, is really an active manager and trying to outperform, or whether they're an indexer or they're a closet indexer. And so if we look at this idea called active share, it's a measure of the percentage of stock holdings in a manager's portfolio that differ from the benchmark index. And as you can see down at the bottom, the higher the active share, the higher the outperformance tended to be. And so with an active share over 80%, active outperformance for fees ranged between 2 and 2.7%, and outperformance after fees ranged between 1.5 and 1.6%. And what do I mean by active share? So here you have pure indexing. This might be the S&P 500, and it's going to follow its index as closely as possible. Then you have closet indexing, and this is where most mutual funds are. They say they might be active, but in actuality, they're hugging their benchmark because they don't want to get fired by underperforming. Because the greater the active share in the fund, the greater it differs from the index, the greater not only the capacity for the manager to outperform, but the greater their career risk, the greater they have to worry about the short-term underperformance where that might cause people to sell their fund, or you also have to worry about relative performance compared to the index. People often judge you on a short-term basis for that. And so because investment managers are people too, they have emotional reactions about their investments, which causes them to panic. And because they're so worried about their underperformance, they just barely tweak what the underlying index that they're trying to beat is doing, and stay much closely. You're actually paying them active fees for a passive exposure, and you're actually likely to underperform. The only way to really differ from the index enough to outperform is to have concentrated stock picks that are much different from the index and have a good process. So just being completely different from the index gives you the capacity to outperform, but it's not sufficient to outperform because the stock picks may perform poorly that year. But when you're looking for an active fund that actually gives you active management, you have to look at something that has a high active share because it will differentiate itself enough from the index that it's tracking. So hedge funds are more of a fee structure than an asset class. And in many cases, many hedge funds are simply expensive mutual funds. The 2 and 20% is a lot more attractive for managers than the 1 to 2% they might earn in a mutual fund. So they'll often open the same exact strategy that they could have opened up in a mutual fund simply in a hedge fund. It makes it more exclusive. It makes it easier to have that mystique where people want to give you money because it's a hedge fund, and it sounds so much better than just a mutual fund, which is accessible to everyone. And if you look at hedge fund returns, here I've highlighted them in the pink box there. You can see that most of the annualized returns, after you correct for funds that have closed down or funds that didn't report their earnings because they did poorly and then closed down, or their returns, because these are all self-reported, they don't do the double-digit annualized returns on average that we expect them to. And while there are no doubt excellent hedge funds out there, on average, hedge funds offer returns in maybe the 4 to 7% range, depending on the category. And this is largely due to the fee structure we talked about earlier. And of course, the fund of funds, which we also talked about earlier, where the hedge fund manager, well, one manager chooses hedge fund managers to invest your money into, and then you pay them a fee on top of the performance fees. And as you can see, the fund of funds is down here at only 3.8% annualized returns on average. On average, hedge funds seem to have lower volatility, so you're getting less risk, and they have a lower correlation to, say, the S&P 500. But you're paying an awful lot to do that. And so there are ways you can replicate hedge fund strategies outside of a hedge fund structure without adding multiple layers of fees. And so that's, I think, a better route to go. Not everyone, of course, can do that, but there are certainly some ways that we're going to talk about later where you can emulate a lot of these hedge funds without paying those exorbitant fees. So hedge funds are often considered an alternative asset class. Again, more of a fee structure than an asset class, but let's go with it. So alternatives, you really need to be cautious with them. And this is because a lot of them are very complex, and you may not earn exactly what they used to earn prior to being a commoditized product. So a lot of the alternative assets that are not stocks, that are not bonds, that are out there have done well in the past because not many people have had access to them. For example, private equity has not been accessible to many people, and it's earned outsized returns. But now as more people try to invest in it through public funds, those returns may be different in the future. Real estate and commodities can be very good additions to a portfolio, but just got to be careful with the type of commodities or the type of real estate that you use. And so the best way to arm yourself when you're looking at alternatives is to get educated. And I'm going to produce some more videos on alternatives to help you get educated on these types of asset classes because they are very complex. So annuities, as we spoke about a little bit earlier, they're insurance products. They are not investments. They allow you to invest in, say, sub-accounts, which are like mutual funds inside of a variable annuity, or they say you get equity-like returns without the risk in a fixed index annuity. But when you really test them, those statements don't really pan out. You're paying a lot in fees, or you're losing a lot of the upside to remove that risk. And oftentimes, when you run the simulations over many different time periods to see how they would have done in the past, these often do not exceed inflation. So if you put all of your money in an insurance product without balancing it out with sensible investments, risk managed investments elsewhere in your portfolio, you're often going to have insufficient growth to outpace inflation over the long run. So certain annuities have their place in the portfolios. That really comes down to the fees they're charging, the features, and what they're offering you in guaranteed income. So one of the ones that a lot more people should look at are the traditional type of annuity, which is a single premium immediate annuity. You pay once, you purchase it, and then you get a set amount of dollars for the rest of your life. And there's some very interesting research that shows that you really shouldn't you may not want to invest in bonds and simply split things between stocks and other growth-oriented investments and single premium immediate annuities. These are different than fixed index annuities. They're different than variable annuities. They're single premium immediate annuities are not complex. They just offer you a guaranteed payout after you pay them a certain amount of dollars. So annuities can have their place, but they should not be the entire portfolio. And I just want to reiterate, annuities do not offer equity-like returns with no risk. You're either giving up a lot in possible returns through fees to have maybe more like bond-like returns, but even in a variable annuity with an income rider, you're then exposed to market risk if you ever terminate the contract or roll it over, because it's whatever the contract value at that point is, not that guaranteed hypothetical income value. So with that said, income rider bonuses, the ones that you see guaranteed 8%, guaranteed 15%, some of them, those don't equal actual returns, and those you can only keep if you annuitize the annuity and withdraw them from your and begin the systematic withdrawals from your portfolio after you've gone through the entire, say, first 10 years where all of the bonuses are accrued. After that teaser period, that 10-year period, generally those bonuses go away when you start withdrawing from your portfolio. And so check out some of my annuity reviews if you have more questions about this on my website. And that pretty much covers it for a lot of the financial products. I don't necessarily think that most financial products are worth the money. That's why there are numerous other ways you can achieve the same strategies without having layers and layers of fees. And over the next few steps in this video series, we're going to go through that and show you how very simple rules can often offer you great risk management and excess returns over the market rate over the long run. And so stay tuned. First, in step 2, we're going to cover emotional investing and why you should avoid it. And then step 3, we're going to cover how the world's best investors use rule-based investing systems to avoid the mistakes average investors make. And both of those will be delivered in the next video. So stay tuned, and I will see you in the next video.